Matt Bloom with Pekin Hardy Strauss Wealth Management, and we're here today for another episode of Managing Your Money. Today, we're going to be talking a little bit about the artificial intelligence or AI bubble that we appear to be in the stock market. To kick it off, I want to talk a little bit about what's been going on. Every day in the news, you see some new article about how artificial intelligence is going to disrupt this industry or disrupt that industry, and take over here, take over there. And the stock market has been reflecting that excitement. I guess, Adam, we'll start with you. Tell me a little bit, is this the next big thing? Is artificial intelligence going to take over all these different industries? Where are we headed with this?
Well, I don't have a crystal ball, so I can't say with certainty, how the future is going to unfold. But there's been a constant increase in the amount of automation in the economy, basically ever since the Industrial Revolution. Mm-hmm. And that's continuing, and that will continue. And it may be that AI is sort of, the next evolution of automation. And it could be a significant one, because instead of automating factory work, it's possible that it's going to automate white collar work, which I think has been impacted relatively less by automation. But whether this is going to completely change the world, or whether it's more just of an incremental next step of technology, I don't know. I think it's hard to tell. I mean, certainly the hype that you read in the newspaper suggests that it's going to be a revolutionary technology. But the news cycle always has these sort of hyper-related events that occur. I mean, 5 years ago, there were predictions going on that nobody was going to be driving their cars anymore today. Right. And that clearly hasn't happened. I mean, there's been more development and automation, but it looks like it's been more of an incremental development, which is very different than what was predicted back then. So I don't know if the predictions today are going to be incorrect or not. I think it's far too early to tell.
Yeah. And Billy or Josh, any thoughts on that to add to what Adam said?
Yeah, well, I'll since you mentioned me first, I'll jump in. I think Adam is right. I mean, what I don't get is I think the stock prices have incorporated in a lot of monetization, which is hard to see happening right now. So you can get an AI app. You can subscribe to one for, I don't know, anywhere from $8 to $50 a month, depending on which app you choose. And that's not a lot of revenue for a lot of these companies in aggregate right now. So it's hard for me to see how the valuations can justify the money coming in from AI. Certainly you need a lot of cost cutting, a lot of job savings, and a lot more revenue to justify where valuations are at. And I just don't see it. I think it's akin to what Adam said. It's akin to when the internet came on, everyone thought you'd have these huge savings, and those savings and efficiencies eventually came. They just weren't there in 1999 and 2000. So I think stock prices got way ahead of themselves, and eventually that revolution it materialized. It just was too early, circa 2000. I think the same with blockchain. In 2017 and 2021. Everyone said blockchain would change the world. We're still waiting for blockchain technology to change the world, and yet prices embedded the fact that was going to happen. So I think this AI bubble is similar to other technology or innovation bubbles that we've seen in the last 20 years. I don't buy it. I think AI will eventually filter its way through to the economy and eventually have profound changes. We just don't know what those changes are or how it will be monetized at this stage.
Yeah. Yeah, it's interesting that you mentioned, the tech bubble there a couple times, and it certainly has echoes of that, that same sort of feeling, right? That it's like, okay, this does appear to be it's a real game-changing type of technology, but is it really, are we actually going to see all the different things that people are predicting that we're going to see, all these different outcomes? Is it going to be something that actually justifies the kind of stock prices that we're seeing? Or is that just a lot of hype, and then the reality down the line will be some real change, but like not something that justifies the kind of crazy stock prices that we've seen?
Matt, Matt,
Yeah.
I've got some charts that I put together for a client presentation. I'm wondering if I could just share them because they speak to this whole notion and comparison to the tech bubble in 2000.
Oh yeah, please do.
Okay. Okay, it's a PowerPoint presentation, but there's just some useful charts in here. So hold on. So what I was trying to do when I was speaking to the client is sort of make a comparison between the NASDAQ today and the NASDAQ back in 2000. And so, and using a couple of stocks to make the comparison, the Juniper Networks back in 2000 and NVIDIA today. This is a chart of the NASDAQ chart, a 10-year chart. And right here is the sort of peak in the NASDAQ, which occurred in March 2000. That's, when everybody was buying the .com stocks, it was sort of the everything tech bubble back then. And then there was a huge correction that occurred during the course of the next 6 months or so. NASDAQ investors really got hurt during that period of time. But then there was this sort of echo bubble a little bit. And you see like the entire index going back up, not back up to the top, not back up to the highs, but a fairly significant amount of the decline was retraced. And there was a bubble narrative that occurred back then too. It was, okay, all these .com stocks have gotten killed, forget about it. But really the growth is going to be from all these internet infrastructure companies, all these companies that are building out the network. And there were companies that were building out the network like Juniper Networks that not only had a nice upturn, but they had new all-time highs. And I think similarly today, what we're seeing is just the beginning part of a historic bubble bursting. So this right chart shows the peak of the NASDAQ at the end of 2021, had a very significant correction, and it has come back, but not all the way, based on the back of this whole AI narrative that's been going on. And so here, now I want to show you, this is Juniper Networks. And at the time that the NASDAQ peaked in March 2020, it had quite a rally and it went down. But after going down, it went up to a brand new all-time high, after which it had, a very rough time of it afterwards. That's what happened in 2000. And similarly, even though NASDAQ has sort of only partially retraced, today, NVIDIA went all the way down to near $100. In October of last year, and since then has quadrupled to a new all-time high. So, I don't know if we're going to repeat what happened before, but it feels like there are aspects of what's going on here that seem very similar to what occurred back in 2000 when that NASDAQ bubble.
Adam, I have a question about Juniper Networks at the time. One of the things that really has differentiated the growth in valuations of all these mega cap tech stocks relative to what was happening in the late 90s was the immense profitability that you see in today's tech stocks relative to the unprofitable stocks back then. And I was just curious on, if Juniper, NVIDIA is, in my view, a very high price stock, but it is also, insanely profitable. And I wonder whether or not that plays a role here at all or not.
I think that they were having lots of revenue demand. I don't remember whether they were insanely profitable or not. I don't have that recollection, but I know that they were showing insane revenue numbers at the time. And, that's also true of NVIDIA. And so, I don't know. NVIDIA has insane revenue numbers, but insane profitability numbers, but I don't know what kind of profitability you need to have to justify a price to sales ratio of, what is it? Like, it's more than 30 times, I think, right now, isn't it?
Yeah.
More north of 40.
Yeah. North of 40. They could have a 100% profit margin and you could say, is that valuation justified?
Yeah, I think look at Cisco, right, from back in the .com era. It was they were highly profitable, and everybody was talking about how they were just going to grow to the moon. And the thing is, they did keep growing profits, right? After the stock crash, the business just continued to grow, and they've continued to be a highly profitable business that's gotten bigger and bigger and bigger, in the last 25 years. But the stock price, it's not a stock you wanted to own all those years, right? So I think there's a big difference. There's a disconnect between being a good business and being a good stock. right? And I think that's where we're at with this, is that, yeah, of course, NVIDIA it's a great company and they're highly profitable and they will see, real business growth due to this AI boom. But do you really want to own the stock at 230 times earnings or whatever it is, right? I think that's the line you have to draw, is that there's this difference between being a great company and a great stock to own.
Yeah, well, I'll just jump in here. I think that it's funny. I thought Juniper was always the poster child for the excesses of 2000, and I think it's the perfect comp to NVIDIA today. I don't remember where Juniper traded at its peak in terms of price to sales in 1999, 2000, but it was exactly the name that I was going to mention if Adam didn't mention it. And today NVIDIA trades at 43 times sales, which is unbelievable. And of course, if we're going to talk about 2000, I'm reminded of the famous quote from Scott McNealy of Sun Microsystems, which I'll read right now because it's so fantastic, and I can't improve on it. So just forgive me. It's very short, but it says it all. Again, today investors are paying 43 times sales for NVIDIA. What Scott McNealy said, and again, it's hard to imagine, but Sun Microsystems was a version of NVIDIA in circa 2000. I mean, NVIDIA is so highly valued today because basically it's the only player that makes these processor chips that are needed for AI, and similarly, Sun Microsystems was building all of the servers that any internet company at the time, or .com company, needed to acquire in order to get into business. So just like NVIDIA has kind of cornered the market for this AI revolution, Sun at the time had cornered the market, or maybe was first to market for the servers that .com companies needed, and so it was trading at a rich valuation. What he said after the fact was, at 10 times revenues, again, that seems quaint by today's standards, at 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain that current revenue rate. Now, having done that, would any of you like to buy my stock at $64 a share? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? And that's the famous Scott McNealy quote at 10 times revenues, and here we are at 43 times revenues.
I think Scott McNealy just lacked a little vision. If he had been a little bit more forward thinking, he could have quadrupled the price of the stock and gotten to where NVIDIA is today. It's a great quote.
It's a great quote.
It's an amazing.
It's great.
Yeah.
You got to give him a lot of credit.
Yeah.
Well, and it does point out the fact that investors don't really change, right? Human nature doesn't really change. People get excited and they herd together in these stocks because they believe that this time is different. The world is going to change, and it's all justified. Any stock price is justified with these kinds of revolutionary changes, right?
Yeah, and what's interesting now, and that's what happened to Sun is maybe not apropos for what will happen to NVIDIA. Time will tell, but Sun Microsystems at the forefront of that internet or .com revolution, when that bubble collapsed at the beginning of 2000, the whole ecosystem collapsed. We saw a little bit of that with the bank collapses that happened this year, although that was short-lived. But as all those companies collapsed during that 2000 to 2002 cycle, Sun Microsystems sales collapsed. Nobody could afford those servers, and eventually Sun was sold for a fraction of its market value to Oracle later on. And so, will that happen with NVIDIA today? I don't know. Whenever this cycle runs out, but Sun didn't survive that cycle, even though it was the poster child of that cycle for a period of time.
One of the things that I don't get, I want to just ask this question is, I mean, interest rates are going up. The one-year treasury is paying 5.4%. Just doesn't seem like an environment where bubbles can persist. And yet, every day, NVIDIA stock price goes up higher. I mean, how long can this go on? I mean, is it 1998 or right now where we've got, 3 more years of more bubble, or is it closer to March 2000? I don't get it.
I think it's a good question. I think what's interesting is the disconnect between NASDAQ and 10-year yields. And historically, or certainly within the last several years, there's been a tight correlation with NASDAQ's performance and the yield on the 10-year treasury. In other words, when the pandemic struck and 10-year yields collapsed, NASDAQ duly outperformed, the argument being at the time that NASDAQ is a long duration trade. In other words, a lot of its companies are currently unprofitable and the profits will come in the future. And therefore, it's a long duration asset. You have to wait a long time for those profits. And as you discount those profits, if the discount rate goes down, those future profits go up, and vice versa. And so as 10-year treasuries went down in the COVID collapse, the deflationary COVID collapse or COVID pressures, and the 10-year bottomed at 0.54% roughly in August of 2020, NASDAQ soared. And then as the Fed began its interest rate raising campaign in March of 2022, NASDAQ collapsed. Throughout 2022, NASDAQ was down about a third. And that made sense. Again, NASDAQ went up when rates went down. NASDAQ went down when rates went up. And going back to Adam's point, the Fed has, while it's slowed the rate of its rate increases, it's still increasing rates. And this year, rates have marched even higher. And yet, circle around March of this year, interestingly enough, right around the bank crises, NASDAQ began to disconnect from rates. And rates began to continue to move higher, and NASDAQ was moving higher as well, which is unusual. It's been inversely correlated. So to get to Adam's point, I don't know. The AI craze really happened at the point of these, and the NASDAQ craze really happened at the point of these bank collapses. So what drove investors into NASDAQ and into AI plays in March of this year? Is it a perceived flight to safety? I would, or is it muscle memory? Is it an echo boom that Adam just talked about? An echo boom really being that people go back to what has worked recently, and what has worked the last 15 years has been tech. And so I guess in a way to answer that question is, it doesn't make sense to me because the correlations have broken down. And something has to give. Either NASDAQ is now uncorrelated completely to rates, and NASDAQ is saying that rates don't matter anymore because perhaps the AI revolution or future profits are so large that it doesn't matter what level you discount them. I think that's fantasy because it always matters. Or at some point, investors will wake up and like a Wile E. Coyote moment, will realize that they're way over their skis. They're way out in the middle of the air. Across the hill, they'll look down and realize that there's a long way to go.
No, that's interesting, Billy. And I mean, it definitely does make you wonder what happened there in March to sort of change the direction of things. And I've seen in a couple different places, some analysts refer to big tech as being like the new safety trade, right? And so it could just be that some of these investors lacking creativity, go back to like what has worked so well, what has been the safe trade over the last 10 years, and and it's been big tech. And of course, then you have I guess one of the big differences between now and back in the .com era was it's the rise of passive investing, right? So the big companies get that much bigger because of all of these passive funds and ETFs, that every dollar that goes into one of these passive ETFs, a huge chunk of it is going to go into these just handful of 5 to 10 really large tech companies, right? Because they so dominate these indexes. So I think that's not necessarily the main driving force, but it's certainly something that I think feeds it, the prevalence of passive investing. But so just
if we can go back for a second.
Oh, sure. Go ahead.
Go back for a second. If you go back to the .com era, and think about all the things that happened. I mean, first of all, there was an enormous number of unprofitable technology companies at the time that were trading at nosebleed valuations, and Pets.com, Juniper, JDS Uniphase, there's a whole number of these sorts of companies that fell into that category. But beyond that, the whole growth sector was trading at a pretty high premium. And the Fed, I don't remember exactly when the Fed started raising rates, but they were raising rates all along the way. And eventually what ended up happening in 2000 was, after all this rate rising, investors started to get a little more concerned given the impact of interest rates. And that was really one of the catalysts that caused one of the primary catalysts that caused that tech bubble to pop. And we're in another rate rising campaign right now. And it's not like when you're rate rising that you raise rates and suddenly there's an impact and the stock market's down 10% like that. There's a lag, and you see the impact. And what ends up happening all too often with these rate rising campaigns is that the Federal Reserve breaks something, right? And in March of 2023, Silicon Valley Bank and First Republic and Signature Bank broke. It wasn't a credit crisis, right? It was an interest rate issue. And maybe it's specific to the types of depositors they have, and you don't see it as a endemic to the banking sector, which I believe is not. It's not endemic. But you're going to see more things break, right? And if you can earn 5.5% with a 1-year Treasury, that's attractive to a lot of people, particularly with inflation at 3%. And so, as incremental dollars start to flow out of stocks and into bonds, you're going to see that impacting these stocks. And it is a buyer beware kind of area, in my opinion. The only thing that I don't know is whether or not we're in the 5th inning, the 7th inning, or the 9th inning. But either way, me personally, I don't want anything to do with this area right now with these kinds of valuations available.
Yeah, I guess that's the ultimate point, right? Doesn't matter what inning it is. What's important is that it's probably a trend worth stepping aside from, because there are other places in the market that seem profitable for the investor to allocate capital to.
Well, and I'll just say this: if it were January 1st, you had no knowledge about what had happened for the first 6.5 months of this year, and if someone were to tell you on January 1st, just having lived through the events of 2022. With NASDAQ crashing at the time as rates are rising, if someone were to tell you that the Fed would continue its rate rising campaign into 2022, and that you'd see 3 to 4 major bank failures, most of them tied to technology or crypto, and if someone told you that despite all that, NASDAQ would be up tremendously this year, it would be head scratching, right? It would not be something that I would have guessed. I would have guessed the exact opposite effect. I would have guessed that the bank carnage in the tech sector would have led to carnage in the tech sector, and that continued rate rise would have led to carnage. In fact, the opposite's happened. So it's curious. And to make one more point, there's a new name. There used to be the FANG stocks, and there was FANG plus MTM, whatever. Now there's the Magnificent Seven. The market today has really been driven by 7 mega cap tech stocks. And if you take those out, it's been the most concentrated narrow market that we've seen certainly in 30 years, maybe even 40 or 50 years. And if you take those 7 stocks out, the market really hasn't moved very much. So everything has funneled into a very, very few handfuls of names, which has driven market cap indexes higher.
When you have narrow market leadership like that, it usually doesn't mean great things for the economy or for the broader stock market.
Correct.
Importantly. Yeah. Well, so real quick, I want to go a slightly different direction with this. So we've been talking about how it's, the whole AI thing is overdone. The stocks are overvalued. There's a lot of risk here. But are there any areas that you all think are particularly interesting because of AI, right? Are there areas of the market where maybe AI is going to make a meaningful difference, and where there might be some value in some stocks? Or conversely, are there particular areas that you think, hey, you know what, because of AI, I don't want to own this type of company. It's going to eliminate this industry or disrupt this industry or whatever? Are there any areas of the market or the economy where you think where it's particularly attractive because of the changes we're seeing from AI, or there's it's particularly fraught with risk? Josh, why don't you take that? I know. Off the
Yeah.
cuff,
Well,
right?
I mean, I'm not interested in being involved in stocks that are really benefiting from AI. I do think that there are an enormous number of industries that will be impacted by AI, both positively and negatively, right? There's an Israeli company that I paid attention to that has location and control systems for tracking cars. And I do know that they use AI systems to look at the patterns in which you drive. So if you normally drive from the suburbs of Chicago into Chicago and every Monday, Tuesday, Wednesday, Thursday, Friday, and then suddenly you get in the car and drive somewhere else and they're trying to track you, they're going to be a signal that maybe the car has been stolen. And there's all sorts of these sorts of AI programs that come into all sorts of businesses that you don't even necessarily know or understand, but it's coming, right? You're going to see, I see the impact of AI in my high school students' life and how, the extent to which they're allowed to do AI, to use ChatGPT and other services in their homework. And the fact that the teachers have to check that stuff. I mean, it's going to be everywhere, right?
Yeah.
I mean, I believe that AI is going to have a bigger impact on the economy. Not bigger, but if you're talking about the internet is one technology, and say Google Glasses on the other, I think it's a lot closer to the internet than it is to Google Glasses. You're going to see this
I'm not
impact.
sure Google Glasses did anything.
Right, but there were people who thought that it could be revolutionary, that you could have the internet on your glasses and just move your head and do a search, right?
Right. Yeah. Adam, Billy, either one of you, any thoughts on that?
Billy, you go first.
Well, I'm not so much, given what I just said, my preamble, I'm not so much thinking about how AI will incorporate into our investments today. And I think I really do think it's a bubble today and it's ahead of itself. Although I do think, as Josh said, it will change the world likely at some point. I just don't know when or how. I think there are other areas that are interesting aside from AI. We tend to go as contrarian investors where everybody's not. And if everybody's focused on AI, I want to fish in places where there aren't a lot of people. Josh talked about, for non-risky assets, short-term treasuries are a wonderful place to park money. You can get 5 to 5.25% returns on, a 1 year and under duration. So that's for essentially not a lot of risk, or buying these low-risk government securities. Energy is a place that I think is still interesting, assuming that inflation is not dead, and given the low valuations of the energy sector, which has been ignored so far this year, it's a very, very interesting place to look at, given all the cash flows and low valuations. Certainly foreign markets are more and more interesting as well. We've had as we've just talked about, a huge U.S. outperformance for the last 15 plus years. And I think eventually foreign securities are likely to catch up and close that valuation gap.
I sort of echo Billy's sentiment, but I want to add to it. I think, and I'm going to sound like a broken record here, but I'm going to use an AI reason to own it. I think gold is kind of interesting here. So let's take two different scenarios. One is AI is just hype and it really has no meaningful difference whatsoever. Well, in that case, when that becomes apparent, this AI bubble that is holding up the stock market, which is probably holding up the dollar as well, because it's attracting foreign capital flows into the dollar, which is holding up the dollar. It probably means that this long dollar bull run that we've had is finally going to come to an end, and the dollar is going to get weaker, and you're going to want to own the currency that can't be printed, and that's gold. Emerging markets also does well in that kind of environment. Commodity stocks also do well in that environment, but gold should do well. But let's say Josh is right, and AI absolutely lives up to all of its promises. Well, in that case, you are going to have a massive, massive unemployment problem, among white collar workers that are the highest earners in the United States. And that is going to grow, that is going to blow a huge additional hole in the budget deficit at a time where we don't need an additional hole because of all the baby boomers that are retiring every day. So if you add a huge unemployment rate again applied to high-paid white-collar workers because computers are replacing them, well, that also is pretty darn bullish for the gold story, I would think. So, you know, I liked gold before the AI narrative. So, but I think I think either way is pretty good for gold.
That's an interesting angle. Okay, well, I guess
Although it'll take a long time to play out.
yeah.
Well, yeah, going back to our 2000 analogy, right? If you had bought gold in September 2000, right around the time that Juniper Networks was peaking, and you held it for the next 10 years or so, you would have gotten about a six-bagger owning gold. So yeah, it takes a while, but you know, that doesn't mean that you can't be pretty profitable with a buy and hold investment. And I think when you're looking at whether you're looking at gold or emerging markets, I mean, I think that, you know, the buy and hold investment over the next 10 years is not going to be AI stocks. It's not going to be US tech stocks. It's not going to be US stocks. It's going to be, you know, something like gold or emerging markets, which are the same asset classes that did so well in the aftermath of the 2000 .com bubble bursting.
I think that's absolutely right. I was going to say, if this period really does rhyme with what happened in 2000, then while all the focus in the 1990s and early 2000s was focused on the internet revolution, .com revolution, really the things that outperformed once that bubble burst in the beginning of 2000 was exactly what Adam was talking about: energy, oil, and emerging markets and commodities broadly all outperformed technology for a long period of time, and I think that's likely to happen at this time as well.
Well, this has been very interesting. Anyone have any final thoughts? Anything else that they'd like to add on this very interesting topic?
Everyone should watch The Terminator again.
I'm gonna go
You know, the
reread that
implications are not
Scott
investments
McNeely
in this
quote
world.
again.
Right?
Okay. All right. Well, thank you all for sharing your thoughts on this. It sounds like, you know, we're sellers rather than buyers in this market. The AI boom definitely appears to be pretty overblown right now, and the stock prices probably aren't actually justified. So we urge caution out there.
Well, I'll add one more point. Sorry, I'll add one
Sure,
more
please
thing
do.
before
Yeah.
and I'll just say this. You know, we had a benign CPI reading that happened last week, and you know, I think in some ways, AI and the Nasdaq boom is discounting this Goldilocks scenario that inflation gets under control, and that we can live in a almost permanent environment of low inflation and low rates and a soft landing and a strong economy, which is reminiscent of the period that we were just in the last 15 years pre-COVID. And if that does come to pass, then maybe these valuations are justified, and so maybe the market is onto something. I would argue, though, that is again pure fantasy. That to me, you know, the biggest inflationary forces that we've seen in the last 40 years cannot be tamed by real interest rates that are the lowest they've been in 50 years, and by a recession that is maybe one of the mildest it's ever been in the last 50 years. So to me, I think once reality comes back and the market realizes that inflation, although volatile, is likely stickier than the market is discounting today, then I think that valuations will adjust.
You heard it here. All right. Thank you all. This has been another episode of Managing Your Money with Pekin Hardy Strauss. You can see this on our website, pekinhardy.com. Appreciate it. Thanks, everyone.